all our attendees today. Happy New Year and advanced Happy Chinese New Year. So this afternoon, I'm very happy to be sharing my outlook for the first half of 2022. In fact, for the whole of 2022. Let me start out by saying that I'm quite happy to see that more investors are bullish today. But that said, I think still a lot of people are a bit cautious. And if you talk to people, you would actually, there are a lot of valid reasons why you should not be buying stocks today. First is the uncertainty as to when the COVID-19 pandemic would come to an end. Secondly, of course, it's the elections, presidential elections this year, and we don't know who will win the elections yet. So there is some level of uncertainty there. So there is this preference of wait and see. Let's wait first what happens after the elections before we actually start investing in the market. Finally, as Anis has said, inflation is a problem not only in the Philippines but globally. And of course, we have the threat of higher interest rates coming from the Fed, and of course, even locally with our central bank. Can we actually not raise rates if the Fed increases rates this year? But that said, though, I think there are some risks to the bearish view or deciding to stay away from the market. First is that COVID-19 actually becomes endemic. Second, there is a possibility that the elections is a non-issue or a non-event. And then third is that inflation, rather than being a problem, is just transitory. And then the stock market could go up despite high interest rates. And finally, although the outlook is cautious, we feel that this cautious view is already priced in. Okay, so first I'd like to talk about COVID-19 being endemic, and I think Anis quite talked about this already. So in the developed economies, they have been able to learn to live with the virus because of, as you can see, higher vaccination rates. So in the US, for example, they dropped the mask mandates when the vaccination rates were at the 40% level, and then in the UK, they declared July 19 last year as the Freedom Day, where all the restrictions from COVID were dropped. No, and you can see the mobility numbers. No, the visits to retail and recreation slowly went up closer to pre-pandemic levels. No, okay, as vaccination rates went up. So that said, what about the Philippines? Well, we have been a little bit slow in lifting our COVID-19 restrictions. But that said, though, you can see that after the vaccination rates ramp up, and especially in the NCR, although here you can see it still is low, but in the NCR, it's much higher because that is the priority of the vaccination rates. So after October 16, you can see how our Google mobility numbers, started to climb up, no? And the retail and recreation visits as of the Christmas time actually exceeded pre-pandemic levels. So there are signs that we are starting to also live with the pandemic, with COVID-19. So other indications in terms of the economy, our third quarter GDP growth and corporate earnings beat expectations, and the fourth quarter numbers were also very good, beating expectations. And what drove the better than expected fourth quarter GDP, which was disclosed yesterday by the government, was actually the consumer spending that was much better than expected, and the growth of which accelerated more than the growth seen in the third quarter. And this might be due to rising vaccination rates and looser quarantine restrictions. Okay, so the Omicron variant, as we know, is more transmissible, and the vaccines don't seem to work because, in the sense that even though you're vaccinated, you do get the infection. But on the positive side, it's less severe, and the duration of surges is much shorter. Okay, so as you can see here in South Africa, you did have a lot more cases, but then the number of deaths were much less. And as you can see on the right side, um, you know, they have a lot of indicators showing that there were less deaths, less severity in terms of ICU admission, oxygen therapy, etc. Okay, and so in other countries like UK and Europe, which of course went through Omicron, they're already easing the pandemic restrictions, and hopefully here also in Manila, they will also be easing the restrictions as I think the number of cases, I think at least in the NCR, is already going down. So as we reopen the economy, if you look at what happened in the fourth quarter, it was actually good news. And other reasons why COVID-19 can become endemic is first, we do have affordable medicine that is now available, like molnupiravir and Paxlovid. And when we don't know if it will happen, but there are some theories or some hopes that the virus could mutate into something that is mild. Is there a possibility that COVID-19 could eventually evolve to the common flu? We don't know, but there are some people who are talking about it. I mean, let's see. Okay, so as far as the elections are concerned, um, the reason why it's hard to immediately conclude what the outcome will be is because in the past, you will see that the early underdogs won the previous election. So, I only have 2016 here, but even before in 2010 and the other years, it it wasn't really the leader who won. For example, I know my chart is a little bit hard to read here. For the presidential election in 2016, Binay was actually the front runner. But then the winner of the presidential election was actually President Duterte. And even for the vice president, the front runner was Escudero, but it was Lenny Robredo who won. And well, you might have your preferences in terms of candidates, but I think what's important as far as the election is concerned is that it is a clean and honest election, and the new president will nominate good economic leaders and have good economic policies. I think that's what the stock market is most concerned about. And then next, well, how has the market performed prior to and after the presidential elections? So 3 months before the election, looking at the past five presidential elections, the market actually goes up by a median rate of 8.1% during the past five elections. Okay. And then 3 months after the election date, you will see that the market also went up by a median rate of 8.1%. Okay. 6 months later, well, it's more mixed, but it's still up. So it's hard to be bearish. Okay. So if you look at the candidates here, it's actually a mix of presidents who were considered both good and not so good. Okay. But you might say, so how come during the time of ERA the market was so weak? You might judge it's because he's viewed to be a bad president and he was impeached, etc. But remember, 1998 was the Asian financial crisis, and that's the main reason why the market did not perform well. And it doesn't really have anything to do with President Erap when he was elected. Okay, and then inflation. Well, it could be transitory. I don't know yet, but I think um, it's too exaggerated to be overly concerned about it. As Anis had mentioned, the reopening of more economies will be addressing the supply chain issues. Okay, so that's something that I do agree with. And the second, factor that really is not talked about much is that the strong demand for goods that is driving inflation might not be sustained. So I'll talk more about it later. And finally, the expectations of higher interest rates in the US, strong US dollar, is actually not good for commodity prices. Okay. So here are the reasons why the strong demand for goods might not be sustained. So essentially in the US, what happened was when the pandemic came, people were locked up in their homes, and of course, the government gave them subsidies, right? So what happened was people couldn't spend on the usual things that were service oriented, like going out to the restaurant, watching movies, etc. So instead of spending on these services, they ended up spending more on goods. So as you can see here, the ratio of durable goods to services went up in the US because they were locked down. So they ended up just going online and buying goods, and they had a lot of money. But as the economies reopen, and as the threat of COVID wanes, you may see people spending less on goods, and of course, buying more or spending more on services. And secondly, you can see um, the another thing that happened was, you know, um, stores had to scramble to get inventories. Okay. And one of the reasons why demand is so strong was because stores were, they ran out of inventories. Okay. Because they didn't anticipate a strong demand for goods. So they ordered a lot of inventories. And in some ways, there's some overshooting also in terms of inventory. I mean, for you guys there who have businesses, I'm sure you are very much aware when it takes a very long time to order your goods because of supply chain bottlenecks, and when prices are going up, what you do is you actually buy more more than normal inventory, because you can't not have inventory on the shelves, because otherwise you will lose the business. Okay, but as you can see, um, it's already normalizing. And finally, if we look at the US Consumer Sentiment Index, consumers are not very optimistic. They're becoming more cautious. And this is because, of course, they're also affected by the high prices. As prices go up, they don't want to spend. Okay, so if they don't want to spend, there is a chance that the spending going forward will be quite weak. Okay, and then the strong dollar. Okay, we expect the dollar to be stronger because of the U.S. Higher interest rates. And as you can see here, there is an inverse relationship between commodity prices and the US dollar. Okay. So, well, that will hopefully address some of the inflation concerns. And well, understandably, you have oil prices, which are also geopolitically affected. But then, as Anis had discussed, you have this option for the US to produce shale oil very easily. And I think the break-even cost is only $50. So now oil is around $90, if I'm not mistaken. So at $90, there is incentive for the oil producers to produce more. And as they say, the best cure for high prices is high prices, because it will attract more supply into the market. Okay. And then this chart is something that I would like to share with you, because especially right now, people are so afraid of the Fed rate hikes, because the view is as interest rates go up, it's bad for markets. But then if you look at this, the orange lines represent the Fed rates. And you would notice actually, as the orange lines go up, the S&P 500, which is the blue line, is actually going up. No, so that just means, the Fed increases interest rates during times of strong economic performance, which is why, even though initially there could be a sell-off because of concerns regarding the higher interest rates, eventually the market goes up because the Fed would not be increasing interest rates if the economy were not strong enough and profits still growing strongly. You know, to for the Fed to increase interest rates. And aside from that, the view is, you can see here, the orange line is the Fed rate, and for the year 2022, the market is anticipating maybe 4 rate hikes or 100 basis point increase. So if you look at this one, we peaked before at 2%, and even if they increase interest rates by 100 basis points, we're still far from 2%. So still very low interest rates. Okay, and another thing is, we view in the Philippines that the cautious view is already priced in. So as you can see, Philippine stocks are very cheap right now. I always share this during the market outlook presentations, because I'd like to point out that maybe the headline PE number might not be so attractive. Like right now, we're doing 16 times PE, okay, which you may say, well, that's not so low anyway. But if you look at it, you could see that the majority of stocks are still trading below their historical average PEs. So anything below zero means that these stocks are still trading at a discount to their historical average PE. So there are a lot of them. And as you can see, the foreign investors have been selling the Philippine market consistently since the fourth quarter of 2019, to the point that if you just add all their net buying and all their net selling since year 1999, they've actually sold everything that they bought during the past since 2010. Okay, so they're that underweight in the Philippines. Now, that said, if there's some bad news that comes out, what else is there to sell? They don't have anything anymore because they're so heavily underweight. And there are other positive things about the Philippines that I'll just skip over right now. Government spending this year is still set to increase by around 11.5% to 5 trillion. So that was passed. And if we exclude the debt burden portion, the actual spending is going to increase by 13.6%. Infrastructure spending will still go up. Then aside from that, I think worth noting are the pro foreign direct investment legislations, because I think that's one of the weaknesses we have. We have poor foreign investments in the country. So, for example, in 2021, we passed the CREATE Act, which reduced the income tax rate to a level that is more competitive with our neighbors. Then this year, during the fourth quarter, the amendments to the Trade Liberalization Act, the Foreign Investments Act, and the Public Service Act were, passed, or at least, they will be passed soon. And these will make it easier for foreign investors to actually invest in the Philippines. And finally, there was the lifting of the ban on open pit mining. So, this makes me hopeful that, aside from government spending, we'll also see um, more increases in investments as a driver of growth, no? Okay, so that said, our strategy on the stock market. Okay, as I've said, despite the numerous threats and risks, we recommend to stay bullish on the stock market. Our view is the reopening of the economy will drive profits of corporates higher. But that said, we believe that volatility will remain. But even though the stock market will be volatile, we are recommending investors to buy on dips. Okay, so what type of stock should you buy? We recommend focusing on large cap issues and also the value stocks, the cheaper stocks. This is because large cap stocks usually lead recoveries, because they're the stocks that fund managers focus on first before they rotate to the smaller ones. And focus on value, because this would allow you to minimize risk. If a stock is paying cash dividends, that's much better, because at least this will compensate you for holding on to them while you're waiting for them to go up. And aside from that, there are indicators that there is a preference right now for cash dividends, because it seems to show that the company is trying to, enhance shareholder value by sharing some of the returns through cash dividends. And finally, avoid buying expensive stocks. I don't think growth at an expensive price will continue to be the theme this year. In the U.S., for example, due to concerns of higher interest rates, we can see that the high flying stocks that are very expensive are the weakest right now. So a similar trend might actually happen here in the Philippines. Okay, so here is a list of the stocks that I like. Um, every month, actually, I come out with an article calling the Shots Report, and it's the same list. For you will see here that there is actually a good mix of reopening plays. Okay, like the holding companies that are will benefit from the reopening of the economy, the banks, okay, BDO, BPI, Metro Bank, property companies, Ayala Land, Robinsons Land, Mega World, okay, and some defensive companies, okay, like for power, we have Aboitiz Power, then PLDT, telcos, the demand of which will continue to be strong regardless of what happens because of the strong demand for data. And then, of course, the REITs for their high dividends and stable earnings. And then, of course, the consumers are also reopening place. So we like DNL and Pure Gold. So actually, compared to last month, the change that happened here is I removed Monde. So later I'll be talking more about this, but in the interest of time, this is the list, and as you can see, a lot of them actually pay out some level of cash dividends, with the telcos and REITs giving out the higher cash dividends compared to the others. And all of these stocks are trading at reasonable valuations in terms of PE, price to book, and they have reasonable upsides to their fair value estimates based on our forecast. So, in summary, it's easier to be bearish than to be bullish today given the numerous threats facing the economy and the stock market. However, we're remaining bullish as the threats, in our opinion, are already priced in and may not be as bad as they seem. Okay. Admittedly, the threats will increase volatility of the market, but because of this, we are um, recommending investors to buy on dips. So manage your risk by sticking to large cap value stocks and avoiding expensive issues. Okay, stocks that pay cash dividends are preferred as they compensate investors who are waiting for the market to recover. So with that, thank you very much.